We are having a panel this afternoon to follow up on the papers in the market structure technology line. And we have three really distinguished folks to join me today. In order of the alphabet, we start with Gregg Berman. He is a Princeton-trained physicist. He's a former senior executive in both the Division of Trading and Markets and in the unit that is now the Division of Economics and Risk Analysis, DERA, at the SEC. He currently serves as the Director of Market Structure Research at Citadel and a former colleague of mine. That's Gregg. Next, we have Jonathan Brogaard. Dr. Brogaard is a professor of finance at the University of Utah's David Eccles School of Business. His research interests focus on market microstructure and empirical asset pricing to examine the impact of automated and high-speed trading on equity and commodities markets. And finally, we have Peter Dixon, who is a financial economist in the Office of Markets within DERA at the SEC. And Peter joined the SEC in 2018. My name is Jonathan Sokobin. I currently serve as the chief economist at FINRA. I've previously held senior positions at both the SEC and the Office of Financial Research inside the Department of Treasury. So we're going to start with a couple of questions from my colleagues. I'm going to encourage folks listening, if you have questions, please put them into chat. We'll be monitoring them, and we want to engage a conversation with each other and with you about where we think financial markets are, where they may be developing, and where we think research has a role in informing us. So let me start with the first question. Actually, before I do that, two things. One, on behalf of all of us, I want to thank the organizers for including us in this project. It is always an exciting and interesting opportunity to hear the research, to interact with each other, to interact with you in the course of this session. And for myself and my colleagues, the comments we make represent our own and not necessarily our respective regulator or employer. Feel free to make it again if you need to, but I want to at least cover it on a blanket statement from the beginning. Peter, I want to start with you, and I want to ask, I'm going to ask all three of you the same question to start. Can you think of, or can you name one or two recent innovations in securities markets or financial markets that you think are going to be really important and for which additional research would inform the public debate?
For sure. I just want to make sure, is my audio coming through clear? Great. So what I've been thinking about in terms of this question is really just kind of the recent explosion in retail trading. Now there are a number of innovations that have kind of led to this. The easy to use app-based trading platforms like Robinhood, and then that going along with commission-free trading, and that is also inextricably linked with payment for order flow arrangements that kind of fund platforms like Robinhood's zero commission trading platform. And I have to apologize for my voice. I got quite sick this week, and so I'm recovering, but I still have scratchiness, and I will maybe not be as clear as I would normally be. But for me, one of the big things that we still haven't really gotten that we need to understand better is this explosion in retail trading. Now, normally when we think about like retail trading, I think, that's a good thing. We want to get retail traders involved in the stock market. That's a great way for them to join in the economic growth of the economy and to build equity and things like that. But on the other hand, there's also concerns that perhaps gamification of trading leads to over trading by retail traders, and so they're actually not pursuing, portfolios that would be optimal for them. Although these trading strategies might be more optimal for like Robinhood because they induce more trading, which gets more trading volume, which produces more order flow for them. And so on most sides, when I think about this explosion of retail trading, I can think of pros and cons to it. And so people often times knock like the payment for order flow kind of way of doing things as bad for retail traders, and I can see that because it disincentivizes optimal execution. But on the other hand, the alternative pre-zero commission trading was typically the multi-dollar per trade or per transaction trade that the brokers charge. And so it's not clear to me which one is actually cheaper for retail investors, being charged a couple dollars per trade or going through a payment for order flow sort of mechanism. And then on the other hand, there are kind of broader issues, which is like a lot of institutional traders would love to be able to interact with the retail order flow because it would help minimize their transaction costs, but they're unable to touch it because it almost all gets internalized. And so this and then obviously the exchanges would like more of that retail order flow to come to the exchanges because it would hopefully lessen some adverse selection on the exchanges. And so just the fact that retail trading has become such a large fraction of total trading volume, and really this has only been within the last year or so, has really changed the way equity markets work. And I think it's something that there's a few papers out there that I've seen that start to get at this kind of the effects of these retail traders on markets. But I think there's a lot more work that needs to be done for us to really understand how this explosion in retail trading, it really is matriculating through the market, and what are the actual, like, can we quantify the pros and cons for both the retail traders and for the market as a whole. And so this is one area that I've done some thinking about to try and get my mind around what is it how is this changing things? And I just also, I guess before I wrap up, I just need to echo what Jonathan said, which is that anything I say does not represent the SEC. It represents my views and should not be construed as representative of the commission, the commissioners, or any other member of the staff. And because I know that Chairman Gensler has talked about a number of these issues, and so I don't want to be stepping on his toes at all. But when I think about recent developments in equity markets, to me, one that is forefront in my mind that I would like to understand better is the overall impacts of just retail order flow, or really the explosion of retail trading.
One of the things that's really so interesting with that, Pete, is, I learned a long time ago that when you actually don't know what you're paying for a good or service, you may be paying more than you think you are. And so in a system where transparency around the cost of services is really important, trying to understand whether, what these trade-offs around as they relate to what people are actually paying for, what the compensation is being given for the provision of liquidity. Some people argue that effectively liquidity provision for retail order flow is become at or near zero. Others are suggesting that it's being subsidized by other activities. So I agree with you. It's a really, really important topic. I think that's a natural pivot to turn to Gregg and ask you, from your perspective, what are...
Well, Jonathan, I was just going to add, there's a great saying, people talk about this all the time in the world of like internet marketing, internet trading, which is basically, if you're not paying for the product, you are the product. And I think that's absolutely true in the case of a lot of these retail brokers. I know Fidelity does things a little bit different, but a lot of the retail brokers, the product that they're selling, they're not necessarily selling a product to us, they're selling a product to Citadel. And we are the product that they're selling to the internalizers. And so understanding that is important.
Well, there may be other people besides Citadel who are purchasers.
Right.
And I will still turn over to Gregg.
Sure. So thanks, Jonathan. So I certainly would agree with Peter that the so-called retail phenomenon is probably the most interesting thing about this. I probably disagree with Peter just spent on every other statement on that. But not because of the specific statements, and first, just to take a step back, it's awesome that the audience here are PhD students, either people who are finishing up the PhD, starting their PhD. And I think the key to being a PhD student, as Jonathan mentioned, I have a degree, my degree is actually in physics. And in physics, one would expect that either there's a right answer or a wrong answer. I mean, the world either works a certain way or it doesn't work a certain way. But even in physics, it's very, very gray. And the goal, and a lot of my own research, has been trying to cut through what is it that everybody says and what's real and what's not real. And the more you get away from hard sciences and into just how people behave and act in society, the more or the less there's right and wrong answers, and the more gray it becomes, which means it is that much more important to get your facts straight. So what I would hope is that going forward, the next round of research for the next 3 to 5 years would be by students, a lot of people out in the audience today, who basically question everything and say, it's fun and it's easy to use cliches and stuff like that, but we really don't know, because a lot of the fundamental facts are just either not understood or incorrect. And the type of research that I would hope people would start to engage in would be research about retail investors, with retail investors, or about institutions with institutions. A lot of research goes on about what people think other people think that retail should do. But I very, very rarely see any research that's actually about retail investors themselves. What do they actually want? What are they interested? There's a lot of people who use online platforms for other things that are besides trading. It's fun to say, well, if you're not paying for something, you're probably the product. But and Peter, I don't disagree that that's an important statement. But it's a cliche, right? And in the end, you sort of have to get to the bottom of trying to understand what is it that those parties actually want. And there's just not a lot of research on that. There's certainly a lot of people vote with their feet, and they obviously have voted by making choices about how they want to trade and where they want to trade. But getting to the bottom of what drives them, what are they interested in, and why do they act the way they act, is really empirical research that I think is in tremendous need right now to better understand that. Otherwise, what we wind up with is rules and regulations that are on behalf of parties. No one has actually asked those parties whether or not those rules and regulations are desired by those parties. So that would be the area where I would think would be probably the most important and upcoming. That is only possible now and over the next few years. This is research that really couldn't have been done even 5 or 10 years ago. I know FINRA, Jonathan, you now have access to the consolidated audit trail, which was a 10-year project in the making. So for the first time, regulators have detailed knowledge and transparency that does actually go down to the account level. So they can see who are retail investors, who are not retail investors, to try to get to the bottom of a lot of these questions that we've just sort of been, as an industry and as regulators and as academics, hypothesizing about. But it'd be really good to be able to get to some of the facts over time.
So Greg, that actually permits me to ask you and Pete a question. You both know this well, that the SEC, the plan adopted to run the CAT and approved by the SEC, specifically prohibits the use of these data by researchers. And so the question is, given all the really important questions that are associated with data privacy, how do we find a way to facilitate that kind of research and maintain that fundamental privacy and protection for the individuals? Sure.
Well, I think so. You're exactly right, Jonathan. When CAT was first adopted, there was a question: would external researchers, academics, have access to CAT? And the answer at that time was, we don't even have a CAT yet. So why don't we wait and let's get the thing going before really contemplating that, because it does bring up a lot of privacy issues. So the answer at that time was basically no.
Well, it was affirmatively no,
Yeah.
right?
Oh, yeah,
It
no,
was,
yeah,
it was affirmatively no, not, well, let's wait and see.
Yeah, no, you are correct. Right. So the answer was that you can't have access. I guess what I would say though is that both FINRA and the SEC and the SROs have a lot of researchers, right? You know, Peter's a researcher, works at the agency and does have access to that data. So I think the first step would be for researchers at regulators to start to make use of that data. From there may be subsets of information or other ways of producing data sets that would completely obscure any underlying information and would not be of a privacy concern that the commission may or FINRA may decide that it is viable to share. But I think that it starts with starting with that underlying research.
So let me thank you on behalf of the SEC and FINRA for encouraging this group to think about careers as researchers in securities regulators. I know that we are always looking for bright and motivated people to come join us and work on a variety of very interesting topics.
Anything I can do to support that.
Tipping that. Let me, yeah, go ahead.
So my thoughts there are when Gregg was talking, I just want to go back a bit. When Gregg was talking about wanting more research into like what do retail traders want and how do we actually service those needs, that's a very good point, and that's a point I expect someone in industry to make. Because that's how you sell your product, is you figure out what the consumers want. And from the regulator's perspective, we're more concerned. We get a little bit concerned about, because this happens a lot. I don't know what the right word is, but we're concerned that companies sometimes get, I should not say we, because that feels like I'm talking for the SEC. I sometimes get concerned that companies get really good at getting what they want by giving people basically what they want, which doesn't always in net turn out good for the person selling their data product. And I think, and I'm not saying that Citadel's relationship with any of the retail traders is necessarily doing this, but it's something that we're on the lookout for. Are the products being offered to the end trader, to the retail traders, really in the best interest of the retail traders? And then on the data front, though, I agree. CAT is awesome, and we at the SEC we like CAT, and I guess the only issue we have there is that there's only like 70 PhD economists at the SEC, and of those, only a handful of them are interested in microstructure things. And of those, the ones who actually have the spare time to work on CAT-related projects is pretty limited. And so, I mean, I know it's the statute, and I wish it wasn't this way, but CAT is a great step forward, and we're still at the SEC learning how to optimize it. Simply because it's only relatively gotten up and running, but I feel like we are beginning to get our fingers wrapped around how to use CAT more effectively in the various rule makings and research things. Releasing anything with CAT is a different issue, because that anything with CAT that wants to be released to the public, even on an aggregated level, requires a commission vote, and so there's just a lot more work. And so so I will say, rest assured, like, we are certainly using CAT, and we are using probably a lot more than the public would realize, simply because we can't disclose to the public what we've been using the CAT for without a commission vote, which is just, I guess it's just the way the rule is written, and I wish it was more open, but that's kind of the way things are.
Jonathan, you've been quiet and patient. I will say, I think this may be the first time that I've been on a panel with another Jonathan. We'll just have to wait if someone sort of names us who goes first. So let me turn it to you.
Well, thank you. I think it's my first time on a panel with two Jonathans as well. So I'll just assume any questions are to you. I agree. Retail trading is a really big topic. I think, we have a better sense because as academics, we don't have access to, user level ID data and US equities. But over the last couple of years, there's been some ways to proxy for it pretty accurately. And now we've had a sharp change in retail investing. And so I think it's certainly gonna generate some academic interest, and not just in equities. I think the options market too, especially, you've seen this striking change in a handful of tickers that have really seen a large change in retail options trading. I'm gonna deviate a little bit from the retail side and talk a little bit about a bigger research theme that I've been thinking about for a while now, which is more about the market structure design. And if I had to narrow it down to something more specific, it would be data fees and fees in general amongst the exchanges. We had this really interesting evolution over the last 20 years of how our mainly equity markets have evolved. We went from sort of pre-Reg NMS, where there was just a very few select number of exchanges and high concentration of volumes on those exchanges, to post-Reg NMS, where if my data are correct, we saw 84 ATSs, alternative trading systems, in 2011. So there's an explosion of ways to trade. And you saw all these startup exchanges, many of them have merged with others. And so there was this consolidation. But I was giving a talk at a similar time last year, and there were 3 new exchanges in September that were coming online in the equities market. And so, we look as academics quite a bit at specific rules on exchanges and, specific order types and things like this. But I think there's a lot to think about in terms of stepping back and saying, okay, are we in the right environment? Are we creating the right ecosystem for trading to be as beneficial as it can be to all parties involved? And to narrow that down, the area I've been looking at recently is on data fees. The SIP is great. It's been greatly improved over the last decade, but it's not the fastest and it's not complete. It doesn't have all the information of exchanges. And if you are really concerned about best execution quality, the SIP by itself may not be sufficient. And so you have to go to the exchanges. And I think there are 15 or 16 registered exchanges right now. And that's 15 or 16 venues that you're buying data from if you want a complete picture in as real time as possible. And that's a very expensive proposition. And what is that doing to the competition of traders? What's that doing to the people who can and cannot play in this level of data?
So I think there's actually closer to 25 or 26 exchange licenses out there right now. But the question you raise, I should say, there's sort of a joint decision about the amount of fragmentation and the way information flows and potentially the cost of that information. There are 2 questions I have for you. First, I would love for you to sort of speak to us a little bit about the nexus of those issues.
Yeah.
The other thing that I think that I've been thinking about, particularly on payment for order flow, is we don't often compare it to the price improvement that's being provided. So, the existence of a conflict and the relative size of the conflict is something that I don't know that we've paid as much attention to, and I would love to get some perspective from you or the others on that as a thought.
Yeah, maybe I'll let someone else talk about payment for order flow, just because I've only tangentially sort of looked into this. I'm happy to give my 2 cents, but I'm probably not the most informed person on this panel. But in terms of the questions regarding data fees, so we've seen this consolidation of high frequency trading firms over the last decade. And I couldn't tell you causally that this is the case, but I would suspect it's because it's expensive to run a high frequency trading firm. There's a lot of data out there, and all of it matters if you're doing things at the millisecond or sub-millisecond level. And so is that stifling innovation in, liquidity provision, or price discovery, or is it preventing manipulative behavior? I have no idea which of those are the right answer, but I think it's important. We saw a bunch of firms that sort of spun off or started up 15, 20 years ago that now are the dominant algorithmic traders, and there's very few instances of that still occurring. So are we just at the optimal equilibrium of firms sort of who've come along and are providing their services, or is there limits to competition because it's expensive to participate? Now, my priors are pretty mixed on this. On the one hand, exchanges are for-profit businesses and it's their data. You don't have to buy all 25 or 26 exchanges. Now it's an even bigger number than I was working with before. You don't have to buy all of those, and you will get. I don't recall the exact regulations, but the SIP will give you a very near, correct price all the time. It's just going to be slightly slower, and you're not going to include things like the depth. But on the other hand, having a price also has a public good to it. Knowing the price of a stock at a given moment, there's a public quality to that as well. And what's the right trade-off in protecting the efficient price at the sub-millisecond level versus letting the exchanges sell it to those willing, to pay a premium for it. So I don't have answers, which is the problem. But I guess that's a good thing because, like we've said, we're on a panel with a lot of rising stars, and they can figure out the answers. We're just posing the questions.
Well, sometimes they got to figure out the questions too. Greg, I see you're off of mute. So would you like to add to this about fragmentation, about all this whole sort of collection of issues?
Sure. So Jonathan spent some time talking about data fees and just the idea that there's a lot of data. So first, that's completely correct. In order to be competitive in certain aspects of the market, one needs to be able to collect a lot of data. However, one doesn't need to collect that type of data for many other activities. So obviously, the typical retail trader doesn't need any of that information. Other people have bought it and use it for them. So that's in the same way that I do not need to own a jet engine. I do not need to own 2 or 4 jet engines, but I certainly make good use of them whenever I fly to visit Florida to visit my family or something like that. But I do leave it up to Boeing and Airbus to figure out how to procure those jet engines and maintain those. So one doesn't need to be the first line, obviously, but if you do want to make your own airline, then yeah, you have to know how to get jet engines and have to pay for airplanes. So a lot of this depends on where we want to focus on the levels of competition. Certainly in data, the SEC has spoken pretty clearly and has a very concrete plan for enhancing the SIP, adding things to the SIP, competing consolidators to try to address some of the different aspects. However, if I look back and you try to see where are the primary costs that may have caused either consolidation or other aspects, I think that one's pretty straightforward. It's people. When you get to the market is extremely competitive. It is a hyper competitive market, and when you have a hyper competitive market and lots of smart people, you're paying for people. So it's just a matter of, do you have better researchers? Do you have, are you gaining the best insights from the best PhD students that come out of programs? How do you compete for people? So a lot of the intelligence and a lot of the ways that things do really derive from what people bring to the table. And I have found by far that tends to be a much larger cost.
So I'll add a couple of my thoughts. So first off, I've thought, and I would love to hear other thoughts on this. The consolidation in the HFT space, to me, seems a very natural reaction to kind of the nature of the market there. Whereas, literally by the definition of the name, high frequency trading, you're trying to trade on speed. And so in the HFT space, you can't have multiple people being the fastest on the playing field. And so I've always kind of expected the HFT space to consolidate, because it seems to me like it's kind of a winner take all type market, or maybe a 2 or 3 winners take most sort of market, just by the nature of the competition there. And so then the question then becomes, once again, like, is that the optimal structure that we want for our equity markets? I remember a while back with the transaction fee pilot, reading a lot of the comments that came into the SEC on that rule, and I know that the courts ruled against the SEC on that. But a lot of the comments came through is a lot of the institutional traders were kind of they were not friends of the HFTs, because they basically said the HFTs have become so fast and they've monopolized the market so thoroughly that it is almost impossible for me to trade with another fundamental trader in the markets, because I can never get to the front of the queue. And so I'm always in the position of taking liquidity from an HFT. And from the HFT's perspective, that's exactly what they want, because most HFT profits, from what I don't know if I want to say most, a large chunk of HFT profits simply come from just market making strategies, earning the spread. And so if the HFT can insert themselves in between every single trade, then they make more money. And so these are open questions about kind of, and these are hard questions to answer as an academic, but there's something we have to wrestle with as regulators, which is like, what is the optimal structure for the market? I also think that in terms of the proliferation of exchanges, this is something that I still think we don't have a great answer of. I mean, if you want fascinating reading, go through the comment file for the transaction fee pilot, and it will talk, and you'll hear a lot. You'll get a lot of comments about like fragmentation or the market data rule that the SEC passed a little while ago. Just go through the comment file, and you'll see how many different sides to this there are. And I would love an enterprising PhD student to go through that comment file and find like good research topics, then help them answer for us, because regulators are often in the position of, we don't have perfect data, but we need to make a decision. And so we just kind of, we use the best that we can and make an educated guess. And we would love those educated guesses to be more educated in terms of what we think the optimal way forward is. Because I still don't know if you gave me like ultimate power to build market structure however I wanted, and you said you could have this like wildly proliferated market, or you could have just one exchange does everything, or anything in between, I don't know where I would draw the line right now. I don't think that we have a great sense of that as in terms of as economists yet. We have, and just seriously, if you want fascinating reading, just go through the comment files on any of the market structure rules that the SEC has posted, and you will see lots of different perspectives and lots of different trade-offs with any decision you make in terms of fragmentation, less fragmentation, market data, transaction fees, payment for order flow, wholesale internalization, like any of these things. There are lots of different sides to consider.
So it feels to me as we're having this conversation together, there are kind of 3 legs to the stool, right? We've talked a little bit about incentives, and we've talked a little bit about governance, but the third is really technology, right? And it's sort of the governance over the technology as it exists, as it can develop, and the governance around it to ensure that markets remain fair for all participants. Let me start with you this time, Jonathan. Talk to us a little bit about sort of the technology issues you think that are starting to evolve, and where, again, you think researchers could help inform a policy debate. You're on mute.
That's sometimes when I say my best comments. The technology issues, I think we've seen huge leaps forward in technology. I don't think that's going to stop anytime soon. I think data are going to get bigger. I think we're nearing things hitting their limit in terms of speed. But I think and I will throw this towards Peter a little bit, but that regulators are probably playing catch up right now in terms of technology and data flow. But things like CAT being, they have the access now, but now you need to be able to analyze probably petabytes of data in not real time, but in near real time, is a real issue. But one that I think we're making advances towards handling, and I have no doubt the SEC and the CFTC will be able to handle these things. But it'll be a rocky road getting there. I guess in terms of the technology, we've seen a lot of technology changes, but the fundamentals, the underlying economics are the same. There is not a lot changing there. You're trying to avoid adverse selection. If you're an informed trader, you're trying to minimize price impact, and we're just in this tug of war of who gets slightly more ability to hide versus detect adverse selection.
So I will tell you that the meme stock event of last January was really the first time that regulators had an opportunity to use the CAT data to do forensics, both the equity and the options data, as you noted earlier. And Pete put a comment in the chat about short interest or short positions and things like that. So I can tell you that the insights that we are able to generate are actually very different than they were historically. The question is what to do with those, right? And that's always the challenge. Greg?
So I think that there's hasn't been a real burst recently in technology trading that is different from the fundamentals of the economics, as Jonathan said. The underlying economics are all the same. Whenever anybody talks about technology recently, it's just sort of fashionable to point to crypto. That's new. Those are using some new technologies and new standards. And one can have a separate panel on what crypto and blockchain technologies, where they're useful, where they're not useful, how would they be used. That's almost a separate category. But in terms of just the underlying trading technologies, I guess I've seen almost like a barbell effect, which is you have significant improvements on both sides of the spectrum. So what spectrum am I talking about? The spectrum would be, on the one hand, you have the fundamental buyers and sellers, retail investors, institutional asset managers. Then you have the whole chain, everything that happens in the middle. And then at the end, you generally have exchanges. You have your market centers and exchanges. So I think many people are aware of it hasn't been like a brand new invention, but just the continued application of technology that's now allowed investors to gain more information, to trade faster, cheaper, et cetera. And we just spent 45 minutes discussing the impacts of what that happens. On the other side, when you start to think about exchanges, there's also been some changes that are definitely worth exploring from an academic standpoint. Traditionally, the role of an exchange was to match buyers and sellers. You get buyers, you get sellers, you put them together. It's almost like utility. It's very, very simple. You got to match things off. And the role of everything else was to make the investment decisions, to process the investment decisions, to do the execution, figure out what's the best way to execute, et cetera. But advances in technology have now made it possible for exchanges to build in investment decisions, choices, execution decisions, et cetera, into the exchanges themselves. And that, I think, has some very interesting ramifications that market participants are just starting to think about and realize and consider. So if you're thinking about upcoming, like if you fast forward 5 years from now, you'll find that my guess is we will have a much more complicated exchange environment of order types and methods of trading than we have in the past. So we went through a period of time about a decade ago where things were getting very complicated. The commission actually went the other direction and said, let's try to simplify things. Lots of order types were taken off the table. A lot of things were deprecated, and there was a move to simplicity. Now it seems to not only be going the other direction, but it's also that other direction is now being more supported by regulators as opposed to going the other direction. So when you have all of those new complications, you certainly have new frictions, you have new inefficiencies, and you have efficiencies. And I think what that winds up leading to in terms of what the market looks like in 5 years will be very interesting to see.
Peter?
Sorry, I was having technology problems. It was not unmuting. Okay, so my thought here on technology is I think that it is critical to consider technology with regulation at the same time. And for example, one of the first things that comes to my mind is for example, tick sizes. So typically right now in the United States for most securities over $1, the minimum tick size is a penny. And so for a lot of stocks, this means that the tick or the spread is penny constrained, meaning that the natural spread, if you had like a theoretically infinite degrees of price trading, you would get a spread that's significantly narrower than a penny. And in the markets where markets transact on price priority and time priority. This is where you get a lot of the concerns with, or what the complaints of a lot of the institutional investors, which is if they're trading in a penny stock, then the price priority doesn't really matter that much because everybody's trading at the exact same price, in which case the only thing that really matters is time priority, in which who can get to the front of the queue the fastest. And that is driven almost exclusively by the fact that the price is penny constrained. And so I feel like some of the technology, some of the real heavy push into super fast trading is partially a response to tick size constraints. And I know there's a lot of people who think that that tick sizes that we should have the various tick sizes, and there are trade-offs. If you could submit an infinitely finite price, you could have computing problems, because right now the computers are designed to deal with basically to very quickly deal with relatively small numbers, because they know that the decimals are only going 2 past the decimal, and if all of a sudden, and so you could gunk up a trading mechanism pretty quick by submitting lots of trades that have like 12,000 decimals to the right, and so there are trade-offs here in how we manage the tick size thing. But I just wanted to point that as like kind of one example of how I guess all regulations, and this is something we're very aware of at the SEC, all regulations have unintended consequences. And so, and some of those consequences are going to be to really push technology in a certain direction. I like how Gregg referenced earlier how much competition there is for the brightest talent coming out of, PhD in math and physics programs that there is on Wall Street. And because they need those big brains to help them figure out how to optimally navigate this complex system. And so when I think about technology and the kind of maybe the future of the markets, I can't think of it separate from what is the regulatory structure of the markets going to look like in the future, because the technology is going to be built to optimize what Gregg and his firm wants to do in the future, given the regulatory space that we're in.
Thank you. Picking back on Gregg, when you were making your comment there a moment ago, I was, you brought me back to days of thinking about what it meant to have 2,000 different order types at the same time. But it also made me think that if we were having this conversation a few years back, the market topic that we'd be talking about a great deal is sort of market resiliency. Flash crashes, mini flash crashes, micro flash crashes, flash rallies. And the cat was created in response to that issue. Is that still something of importance, or is it sort of played out as a topic, or what is the? Let me ask it a slightly different way. What's the current version of that question that we should be paying more attention to?
That is a superb question, and you are right, because if you go back even just 5 years ago, the big question was on resiliency. And I guess I would split the question into two parts, one that has a time dimension and then one that has a location dimension. The US tends to be a little bit ahead of the curve, and sometimes a lot of it ahead of the curve, compared to other markets in terms of resiliency and just different ways of thinking about the markets. So I think in certain jurisdictions, they are sort of thinking through how do we keep the exchanges up? How do we keep our data flowing in the same way that in the US we were doing that, say, 4 or 5 years ago or 6 years ago? And most of that has been somewhat resolved. Now, interestingly, one of the benefits of having a fragmentation is a bad word. It just sounds like a negative connotation. Let's just call it dispersed or
1,000 flowers blooming.
Non-uniform, but the idea of one of the benefits of having at least more than one exchange, put it that way, is that if one exchange goes down, the market doesn't go down. And you lose some liquidity, but you might say maybe I lose half liquidity. Well, yeah, 10 exchanges, then you're probably not going to lose more than 10% of the liquidity. If the market goes down, you might not even lose any. So I think the resiliency aspect of keeping the data running, keeping the exchanges up, has been to a good extent solved in the US, but not so much elsewhere. So other jurisdictions are working on that. The new flavor of that, as you said, Jonathan, I think is more around anything that would exacerbate volatility in a way that is not understood and does not fall into the categories of where we are okay with volatility and where we're not okay with volatility. So we've had many discussions over the years, and the industry has and regulators have settled in on these concepts of limit ups and limits down. And we say, well, that's if there's good price discovery, so we keep it going unless it hits a band, and then we hold the market. Where I think the next level is, what if you don't hit a band, but a stock goes up a factor of 3 in 5 hours, but it did it in an orderly fashion. So I think that's where the next level of research really is in terms of resiliency, is trying to determine, much in the way that we try to determine limit up, limit down bands, is that bad? Is that good? Is it okay? Does that provide evidence of a resilient, well-functioning market, or does that provide evidence of not a resilient, well-functioning market? I don't even think those questions have been properly posed and need to get answered. And that's sort of like the state of the art. If you go back 10 years ago and you think about, should we close the market if the market falls 40%, 30%, 20%? What's good? What's price discovery? What's bad and shows that there's some problem?
Do either of you gentlemen want to add something to this, or do you want another topic? All right, I take that as another topic. So
yeah, I don't think I have anything
okay.
to add. I think Greg summarized it well. I think the markets did their test last March, and they passed with pretty much flying colors. We had like a 40% decline in a couple of weeks, and then a 40% rise in a couple of weeks. And I wasn't paying too close of attention, but I didn't hear of any meltdowns. That I think that was a big.
And yet Pete would tell you, we spend a lot of our time as regulators both investigating in events that seem to be different in nature in terms of volatility, both in sort of the macro way, but we've had a couple references to the meme stock event, right? And so that's the interaction of technology and social media and all this other stuff, and it had sort of real effects of trading at a given time. So, yeah. Greg threw out this idea about sort of in an offhanded way about cryptocurrency and the technology around crypto, and these other very different ways in which markets organize themselves. And so, Jonathan, I know that this is a topic in which you have some interest. Is there anything in this space you want to raise, that sort of the application of those kinds of technologies in let's call it more traditional securities markets, the push toward shorter and shorter settlement cycles? Like, how do we start to think about those influences in the broader topic of research in financial and securities markets?
Yeah, so this is when we were discussing topics. I think there is loads of room for work in cryptocurrency markets at the market microstructure level, and I can't say I've seen much on it. That being said, I also don't know a lot about it. There is a bunch of crypto exchanges, and as far as I know, they're unregulated for the time being, because they're not technically exchanges. And I haven't seen anyone dive into their different market microstructures and what the trading environments look like, and which one is better for what types of consumers. But it seems like we're in this huge natural experiment right now. And then to Gregg's point earlier, it seems that a number of the crypto exchanges are also your broker dealer, essentially. And I don't know how having that be how you start combining these entities that we typically think of as sort of separate silos into one. I wouldn't be surprised if some crypto exchanges are also the market maker on that exchange. So I think that I don't know enough about any given exchange to say, well, here's the really unique thing about it. But given that the number of exchanges and the lack of formal regulation on a vast majority of them, there's bound to be some really interesting microstructure questions there.
A lot of thought on the crypto thing, and this is something that crypto people in the crypto world need to figure out. And I think that this is what markets do well, is figure out useful things for crypto. But right now, crypto's not that useful. There aren't very many people who will take crypto as a medium for exchange. Its primary function in terms of a medium for exchange at this point is to facilitate ransomware attacks and other extortion. It uses about 1% of the globe's energy capacity, which is a ridiculous amount of energy. And I'm not saying this to say crypto has no future. I'm saying that these are cybersecurity, energy consumption, and use as a medium of exchange are all things that crypto has still not cracked. And I think that particularly a crypto exchange, because that's often, the exchanges are often the source of the attack. Because while typically for Bitcoin, you get this 64-digit, basically random and not stealable number that does all the transactions. If you can hack into the exchange, you can basically steal everybody's wallets and you can take their money with you. I just remember that there was an article yesterday, I think in the Wall Street Journal, about a crypto hack that got away with $600 million worth of Bitcoin. So I think that the exchanges on a crypto exchange has this added layer of difficulty in terms of being a viable, or in terms of managing that market, is the cybersecurity element. And then also I know Tesla just said they walked back, they're willing to take Bitcoin because Elon Musk just basically said, he's well, basically this just facilitates ransomware, and we don't want to support that. And so crypto has a lot of issues. I'm not dogging the technology per se. In its current iteration, it has a lot of challenges. And these are challenges that smart people are going to have to figure out. And if they do figure it out, I think that this opens up a really interesting way for thinking about the future of stock trading. The future of the distributed ledger technology has a lot of interesting things to think about in the future. I think that they have some really big issues that they need to solve in the present before it really becomes viable.
You're on mute, Jonathan. Jonathan, you're on mute.
So I apparently this is a problem that's particular to Jonathan's. We tend to talk on mute. I don't. Did you want to add something here, Greg?
Oh, I was just going to say on the crypto side, the linkage that we tend to see or tend to hear about when people talk about crypto, but then they talk about the equity markets, tends to be around, hey, if you just put everything on the blockchain, you could do real-time settlement. So that comes up a lot in various contexts, and I guess I've given a lot of thought to that. And at this stage, the speed of settlement is not a technology question. It is there's nothing a technology needs to do in order to make settlement either real time or not real time. These are true regulatory, economic, safety and soundness questions apart from technology. Outside of purchasing a something with cash, from a street vendor, perhaps, there's not too many places in the world where we have real-time settlement. When you use your credit card, knowing that, I can always call the credit card company if I don't get the thing that I thought I got, or I get home and I purchase something from a store and it's broken and the store won't give me back my money. Yeah, well, you call the credit card company and they'll figure out how that works, et cetera. So the idea of real time, like literally real time, you buy a stock for institution buys a stock for $16 million, and $16 million gets transferred in a femtosecond someplace else and back and forth. We don't do that with anything approaching that speed with much more transactions. So improving settlement cycles using whatever technology is available to maybe end of day or go for T+2 to T+1, all that makes sense. But people generally bring up the idea of, hey, if we just had blockchain everywhere, we'd be able to get to real-time settlement. Yes, that might be true, but that's not what's preventing people from going to real-time settlement.
Thank you. So we are fast approaching the bottom of the hour. I want to thank my colleagues for this conversation. Thank you for everything you brought to it. I want to make one last statement. And, as a person who does research for a regulator, having worked for, as I said, the SEC, Treasury, and now FINRA, there is an increasing expectation that regulators will understand the markets that they regulate and the activities therein. And we have access to some data, but what we don't always have is the benefit of the perspective of someone who is sitting from the outside and thinking very carefully, using a disciplined approach in defining the set of issues that are important and providing a framework and evidence in the context of that framework that helps inform a public debate. That's not to say that decisions don't get made in the absence of the data. They do, because sometimes decisions have to be made. We very much appreciate the opportunity to have this conversation with you and get you guys to think about ways in which your interests in research can help inform a broader debate that will affect the shape of both regulation and sort of the evolution of security and financial markets. So let my colleagues say one last word. I'm just going to say thank you again, and let me turn it quickly, Pete, then Greg, then Jonathan.
Sorry, my being weird. I just want to say the interactions like this are great, and working at the SEC is a fun place because we have a lot of interaction with both academics and with people from industry, both in the forms of comment letters and that people send in, and in just meetings that people come through, and that is the best information. Like, nobody at the SEC wants to implement a bad rule. And so we value the insight of academics and the insight of practitioners. And so like for the PhD students here, regardless where you choose to go with your PhD into academia or industry or anywhere in between, the various perspectives that we get are useful. And so dialogues like we're having today are useful in helping us make good regulations, which is kind of what I focus my work on, is helping the commission craft the best, most economically sound regulations possible. So that's all.
Greg, you're up.
Not much more to add. Just thank the hosts for inviting me. I think it was a very interesting panel, and hope that the students watching this got something out of it. And regardless of what field they go in, one of the nice things about going for an advanced degree, especially a PhD, is you learn how to be objective, you learn how to think, you learn how to question everything, and just keep that spirit alive.
And I'll just add, in academics and microstructure, I think learn as much from people in industry, people at the regulatory agencies, as they might learn from us. And so, keeping those conversations open. I've never met someone in microstructure, academic or industry, who isn't thrilled to talk about all of the cutting edge issues. So there's lots of conversations to be had.
Wish you all a good rest of the program, and thank you so much for joining us this afternoon.
Thanks, Jonathan.
Thanks, Jonathan.